Hello, my name is Clayton Kuma and I work at the School of Accounting and Finance. In this session, I will be discussing cash budget for A102 Introduction to Accounting and Financial Management Part 2. A102 is an online course and it is offered to first year accounting students. Before we start discussing the preparation of cash budget, I will quickly recap back the master budget to see where the cash budget sits in this master budget. So you can see on this slide, there are two types of budget, the operating budgets and the financial budgets. Now in the operation budget, we have the sales budget. That's the starting point of every budgeting activity that we do, which feeds into the preparation of the production budget. Now in the production budget, we are producing a product, so we will need all the materials, the labor, and the manufacturing overhead to produce a particular product or service for that matter. So that is why we prepare the direct materials budget, the direct labor budget, and the manufacturing budget. Then from the production budget, we go in and prepare the selling and administrative expense budget. This is to record all the other expenses, which is neither production cost, but they are selling and admin costs. Now all of this selling and admin expenses and all these other costs is now feed onto the income statement to prepare the profit or loss of the company. Now, as you can see from the income statement, we only pick out the cash items to go into the cash budget. That means all the cash revenues and all the cash expenses. Furthermore, the capital expenditure statement, only the cash expense from capital expenditure feeds onto the cash budget. And the final balance of the cash budget will be shown in the budgeted balance sheet as an asset. So that is how important the cash budget is, because it just records all the cash items that comes into the business and all the cash payments that goes out of the business. Now, as a form of introduction to this preparation of cash budget, we all know that cash is like a lifeblood of a business, just like us human beings. If we don't have blood in our system, we will die. And similarly for businesses, if they do not have the cash, of course they will die or they will go out of business, because they won't have any money to finance their operations or to invest. So that's how important cash is. It's a very important asset of the business. So the learning outcome of this session is taken from the course learning outcome number 6 in the AF102 course outline. And it says, describe the planning process with illustrative examples, including the construction of the budgets. So based from this course learning outcome, the following specific outcomes will be discussed in this presentation. That is the preparation of the schedule of receipts, the preparation of the schedule of payments, and the preparation of a cash budget. So in preparing the cash budget, there are 3 sections to the cash budget. We have the receipts, the cash receipts, the cash payments, and the financing. In the cash receipts, it records all the receipts, and the major receipts coming into the business is from the receipts from customers. So this is where the business sells its goods on credit to the customers, and then there's a payment schedule that how we receive the money back to the business. In addition, there is interest and dividends receipts and any proceeds that we plan from the sale of investments, planned assets, and the company's stock. With regards to cash payments, it records all the payments, and these are the payments for materials that we use in the production, the payment of labor, the payment of manufacturing overhead costs, and any selling and administrative expenses. These are all recorded. Now, just to illustrate the point again, that it's very important for us to know that only the cash payment comes in. There are other expenses which are paid, but the non-cash are kept out of this section. A good example would be the depreciation. It's an expense, but it's not a cash expense, so we ignore it. And the final segment of the cash budget is the financing. In the financing section of the cash budget, it records all the expected borrowings. Now, the firm is short of its expected cash. The only way for it to meet that requirement is to borrow money. And if any money is borrowed, of course, it has to be repaid back. So it also records the payment of repayment of the borrowed funds plus any interest that is being charged. So our example for today is already given to you the question is already given to you, so at least you should be able to follow through with the discussion of the question. So in here we're going to prepare the schedule of receipts first. So the schedule of receipts is just to show how the credit sales are collected. Now I've explained to you already that credit sales are sales that is made by the business on that point of time, but the money is not yet received. So what we're going to do is we're going to collect those credit sales over the two period of the budget period, which is January and February. So the receipt schedules is as follows. 50% of the credit sales is received in the month of sale, 30% in the first month following the sale, and 20% in the second month following the sale. So if your sales month is November, obviously 50% will be received in November, 30% will be received in December, so 20% of November will be received in January. So 20% of 250,000 is 50,000. So since we've collected all the money, there's nothing left. Now 50 plus 30 plus 50 is 100%. So that's why we don't have to have any money collection in February. So if the month of sale is December, obviously 50% of December will be in December, so 30% of 320 will be received in January, that's 96,000, and 20% of 320 will be received in February, which is 64,000. Going to January sales, obviously 50% of 360 will be received in January, which is 180. 30% of January will be received in February, which is 108. 20% will be received in March. Now since March is outside of the budget period, we ignore it. And finally, for the month of February, 50% of it will be received in February, so 50% of 400 is 200,000. So 30 and 20 will be collected in March and April, which is out of the budget period, so we ignore it again. So after we record the expected collection for each of the months, we will add them all together. So the total collection we expect in the month of January is 326,000, and for February is 372,000. Next, we're going to prepare the schedule of events. Similarly, we're going to prepare for the 2 months. Now this is from the credit purchases. So what happened here is that it is the firm that purchased the items on credit from the supplier and later pay the supplier. So the payment schedule as follows. 60% of the credit purchase is paid in the month of purchase, while the balance is paid in the month following the purchase. So the balance obviously is 40%. So if December is the month of purchase, 60% of December will be in December, so 40% of 100,000 is 40,000 received in January. So there will be nothing paid, not received, but nothing paid in February. Similarly for January, 60% will be paid in January, so 60% of 120 is 72,000, and 40% of 120,000 is 48,000. If the purchase month is February, 60% of February will be paid in February, which is 75,000, and 40% will be March, so we will ignore that. So this is all the payment schedule, and we're going to add them all together now. So for the January 2017, we expect to pay 112,000, and for February we expect to pay 123,000. So now we're going to put them all together into a cash budget. Now that's the title of the cash budget. We have the name of the company, called the company, and the period in which we are preparing the budget, which is for month ending 2017 of February 28, 8 of February that is. So we start with the opening balance. This is given to us in the question. So we start with the opening balance. That's the closing balance from December coming into January. So we record that in, and then we add all our receipts. So our receipts are made of the collections from customers from Schedule 1 we calculated earlier on, which is 326,000 for the month of January. Then we add all the other receipts. The notes receivable of 15,000, there is sales of security, but we don't have any sales of security in January, so there's nothing there. So after we record all the receipts, we add them all together. So 326 plus 15,000 will give us 341,000. That is your total receipts. Now we're going to add the total receipts to a beginning balance of 60,000. That gives us the total available cash, which is 401,000. Now we're going to record all our payments. So we will deduct all the payments from this total cash available. So the first sets of payment is relation to the direct materials from Schedule 2, which we've done just a while ago. So $112,000. Then the other payments are for direct labor, 90,000, manufacturing overhead, 70,000, and selling and admin expenses of 78,000. These figures of labor, overhead, and selling expenses are taken directly from the question paper. Then we want to add all our payments. So from 112 plus 90,000 plus 70,000 plus 78,000 will give us 350,000. That is our total payments. Now we will deduct these total payments from our total cash available, and that will give us an excess of $51,000. That means we have more cash in than cash going out. Now from our question, you will see that the minimum cash that the business hopes to have is 50,000. Now since this amount is excess or more than 50,000, it will be just carried forward. So that means there will be no borrowings, and since there is no borrowings, there is no repayments. So the final balance is now 51,000. This ending balance now becomes the opening balance for February. So we're going to bring it up again. So it's going up to February 51,000. Then we record all the receipts just like we've done earlier on. So collection from customers 370,000. There is no note receivable, but we do have sales of securities. So we add all the receipts. 372 plus 6,000 gives us a total receipts of 378. When we add with the 51,000, the opening balance, give us the total available cash of 429,000. Then we deduct all our payments. From schedule number 2, the material is 123, the direct labor of 100,000, manufacturing overhead of 75,000, and selling and admin expenses of 84,000. All of that added together give us 388. Now we will deduct these total payments from the total cash available of 429, which gives us 41,000. You can see that 41,000 is less than 50. So in order for us to have 50,000 at the end ending balance, we must borrow money, isn't it? So 50 minus 41 will give us 9,000. So our borrowing is 9,000. So 41 plus 9,000 will give us 50,000. Obviously, the 9,000 will be paid in the future months when we do the payment of the borrowing. So that's how we prepare the cash budget. As you can see, we just recorded all the receipts coming in cash and all the payments that goes out of the cash. And of course, we have the closing balance. This closing balance, if you can refer back to the master budget, this is the one that will be shown in the balance sheet under the asset. So we now come to the end of our presentation. So in summary, we know that cash receipts sections record the expected receipts from the principal and other sources of revenue. Cash payments record all the expected cash payments. The financing section records all the expected borrowings and repayments. And in preparation of the cash budget, it just shows us the anticipated cash balance that we expect to have at the end of the period. So as part of the assessment of this session, obviously there will be a self-assessed post quiz, which will be posted on Moodle for students to attempt. There will also be a selected textbook question that I have selected for them. They have to, and I've provided them with partial solutions, which you can check their work if they can be able to achieve those partial solutions. If they don't, then of course they can make use of the discussion forum where they can post any queries in relation to these activities. That's the learning tasks. With the assessments, of course, there will be an assessed quiz on budgeting at the end of this week, and the budgeting quiz will also include cash budgeting. And of course, there's a major assignment that they have to do, and there's a cash budget component that they have to complete within the major assignment. So I hope that will reconsolidate those ideas I discussed with in this presentation, and that is all for this presentation. Thank you so much.